There's one thing that you can do right now that will have more of a positive impact on your technical trading performance than absolutely anything else. And that is incorporating a good top-down analysis strategy. See, when you trade without top-down analysis, you don't have a full picture of what the market is doing. This leads you to take a bunch of pointless little losses that could easily be avoided. But when you bring top-down analysis into the picture, you'll eliminate all of these silly losses, and you'll also have more clarity on the market and a better understanding of where the market is likely to go, which means you'll be able to take more big trades and make better results as a trader. So in this video, I'm going to run you through top-down analysis. I'm going to show you a top-down analysis strategy step by step and cover all of the small important things that you need to know to optimize your top-down process. Well, top-down analysis is the process of going from the high time frames to the medium time frames to the low time frames to build a big picture narrative of the market. Now, each of these time frames has its own use case. High time frames we use for directional biases and working out which way the market is going, because high time frames provide the most accurate picture of the market. So if we can work out the market's bullish on the high time frames, we have the best possible odds of taking high probability trades. Medium timeframes are for actually formulating your setups. So on the medium timeframes, we're actually refining areas and identifying trading ranges that we can look to trade through. And the low time frame is for actually applying our entry models and getting the entries to our positions. So setting up our entry, our stop loss, getting confirmations, working out exactly where our target's going to be. Each of the time frames from high, medium to low has its own use. Now, another thing is, this is all relative, okay? The markets work in a fractal nature. And what this means is the same patterns are going to be seen on the high time frames and the low time frames. So whether you're looking at the weekly chart or the daily chart, you're going to see the same stuff. You're going to see the same kind of trends, the same kind of patterns. Markets are fractal when you view them from a price action perspective. So there's a level of relativity in what we call a high, medium, or low time frame, okay? We can actually use top-down analysis across any pairing of timeframes. Whether we're day trading or swing trading, it all works the same. And that means we need to consider something called time frame relevancy. So when I talk about time frame relevancy, I'm basically suggesting that we should look to pair the timeframes we're working with logically. That means that we shouldn't go from the weekly to the 15-minute because there's a huge gap in between. And what we see on the weekly could be a bullish trend. But the 15-minute trend could be a totally different, refined bearish trend, and there's no real use of putting these two timeframes together. Now, instead, we should look to follow a process like this, where we look at the weekly, the daily, the 4-hour, and the 1-hour, because these timeframes are all closely aligned, which means what we see on the weekly will correlate into what we see on the daily. What we see on the daily will correlate into the 4-hour, and the 4-hour will correlate into the 1-hour for actually getting the entries with that bigger picture in mind. So you can actually build timeframe pairings for any sector of trading, whether you're scalping the very low timeframes or you're swing trading entirely. But you just need to follow this rule. This is a very good rule. And this is the one step down approach. So when we're looking at a high time frame, for example, the weekly, rather than jumping straight to the hourly or the 30-minute or the 15-minute, we want to take one step down. So we'd go from the weekly to the daily. And then from the daily, we take one step down to the 4-hour. And from the 4-hour, we take one logical step down to the hourly, okay? And that would be a good setup for swing trading, weekly, daily, 4-hour, 1-hour. Now, if you wanted to day trade a little bit more, you could follow a 4-hour, 1-hour, 30-minute, 15-minute step down approach. But here you're building your narrative on the 4-hour, you're identifying setup opportunities on the 1-hour and 30-minute, and then you're using the 15-minute for your actual executions. If you wanted to go even lower than that, you can. You can use the 1-hour, 30-minute, 15-minute, and 5-minute. This is for pure day trading, where you use the hourly to build your daily range, the 30 and 15-minute to work out those magnet price areas, and then the 5-minute to actually refine your entries to get the best possible reward out of the positions you take. So now let's go to the chart, and I'm going to break down a top-down strategy. We're going to look at the weekly, daily, 4-hour, 1-hour, and I'll show you exactly how we actually apply this to the markets to get better trades. Now, I want you to be aware that top-down analysis will work with any style of trading. Whether you're trading chart patterns, trend lines, break and retests of support and resistance levels, or you're trading smart money concepts with supply and demand, liquidity, and so on. It doesn't matter which style of trading you're using, but in this video, I'm going to be using supply and demand focus. So I'm going to run you through just a few things so that if you haven't seen them before, you have a better understanding of them when I'm explaining them in the video. Also, if you want to learn more about these concepts, I'll put some links in the description for full courses and videos that I've made on these. So the first thing you're going to see is a demand zone. This is an area of consolidation before a large up move. The theory here is when the market comes back to a demand zone, we buy. Next is a supply zone. Same concept, a consolidation before a big down move. When the market comes back to supply zones, we sell. You will also hear me talk about imbalances. Now, an imbalance is simply an open price range. So look at these two large areas. There's no wicks, there's no retests. They are open price areas. These are imbalances. Then we have structure. I view markets as higher highs and higher lows in uptrends and lower lows and lower highs in downtrends. So keep in mind when I mention structure, that's what I'm talking about. And finally, liquidity. This is areas where there's a lot of orders. But for reference, in this video, when I mention liquidity, I'm talking about equal high or equal low areas where the market has essentially formed a support or resistance. And when we see this, I expect the market to sweep it. So without further ado, let's get back to the video. I just wanted to make these things clear in case you weren't really in the know with the strategies that I use to trade. The first step in our top-down analysis process is to use the weekly time frame. And the weekly, as we said before, is for building directional biases and also identifying potential magnet areas for price that the market could be pulled into. Now, when we're looking at the weekly, because it's so high time frame, we don't want to look at it zoomed out like this. Because if we identify a potential trade opportunity like this, it's going to take months or maybe even years to play out. So it makes more sense for us to focus on just the near-term range on the weekly. All we want to do is find out where the market's likely to go over the next 1, 2, or 3 weeks. So we can immediately see that the market is trending up. We have these higher highs and higher lows consistently forming, but we've just had a potential change in the trend. So with this potential change in the trend, it's possible then that the market could maybe shift bearish, which as of right now doesn't really matter to us too much, but this builds the first picture as to kind of identifying the magnet areas. So if we know this market is potentially starting a reversal on a weekly, well, we know then it's likely to sell from an open supply. So we have this supply zone here with a small imbalance, which simply means that the market hasn't retested this yet. So I would expect this to act as a magnet for price. So we could say before the market sells, it's likely that it actually makes a push up into here. Now below that, we have as well a demand zone here on the weekly, just there, which has just about been retested by this wick. And now we have a range down here that we could potentially be working with. So we could either see the market come deeper into this range before moving up, or we could see the market push away from this range pretty much immediately. Then we have a range up here, which is going to act as a magnet for price. And we know that we basically have two working ranges at this point from the weekly. We have an area we could react from for a buy. We have an area we could react from a sell. And then the area within this is actually the trading range that we are interested in looking at. So from the weekly, just by looking at the weekly now, we have built two areas the market is likely to react from or go into. So this kind of builds the first picture, which obviously if we didn't look at the weekly, we could miss these kind of things. We could be immediately looking to sell all the way down when we haven't retested this area yet. There's a lot of things that we could miss if we didn't look at the weekly here. So now we're going to go to the daily time frame, and we can actually refine things in a little bit and start to build a better picture here. So from a daily perspective, we can refine the demand zone into this daily demand. So this has actually still been retested, which is a good sign for potentially going long from where we are. In terms of the supply, the daily is not giving us a massive amount more information at this point. So what I would do really with a market like this that's not providing too much more information on the daily to the weekly is drop down to the 4-hour. So this is where we want to kind of identify any lower time frame opportunities and actually start to find our trades. So on the 4-hour here, what we can start to do is refine the areas first of all. For the supply at the top, we could refine down to the extreme zone, which, for reference, an extreme zone is the furthest zone from price at the top or bottom of a price move. So here we have a supply zone. We had a push away, a pullback, and a retest of that supply zone. Then we had a push away, and there has not been any retest of this supply zone just yet. So this would become the extreme zone, which would act as the core magnet area for price if we were looking for buys. So now we have this narrative where we have this area that could be targeted instead. And this is where the lower time frame refinements come in very handy. But what we can also see below is that we have an imbalanced extreme just down here. So we are still trading within an imbalanced range just now on the sell side, right? So as you can see, just to explain that to you, this area here has imbalance left open, which pretty much just means there's open price if you don't know what an imbalance is. And generally when we see open price, it's going to be filled. Now, another thing I can see here on the 4 hour, which leads me to something interesting, is we have these relative equal lows. So we've got what looks like a kind of support floor. Now, from my trading systems and the way that I trade, when I see liquidity, I'm expecting it to be taken out at some point, and that's what these relative equal lows are. They are an area of liquidity. So now, on the 4 hour perspective, what do we have? Well, we have a slightly different picture. On the weekly, we are looking for a potential continuation towards that weekly zone. The daily didn't give us too much more information, but now that we're on the 4 hour, we've been able to refine the supply and say that, okay, if the market is going up, it's likely to go up to here. But we've also found that there's still open space below that we could trade through. So your trades are not always going to fall directly in line with what you're seeing on the weekly time frame. The weekly is for finding those magnet areas and the overall picture, and then we can use that range that we've built to find smaller trades within. So breaking down the 4 hour trend, because we always want to break down the relevant trend, we can see from this high, we had a break of structure under this level just here. We then had another break of structure under this level here. Then we had one more break of structure under this level here. And this downward trending movement actually broke this level, which opens us into this imbalance range. So now I'm thinking to myself, well, the market then is likely to fill the imbalance range before buying. So if we were going to buy, we would first of all come and tackle this demand and maybe even sweep that liquidity that we spoke about. So now we've shifted from having that weekly perspective of buy to sell to potentially finding a 4 hour opportunity to sell, to buy, to then potentially sell. Okay, so we've actually built a narrative within the larger narrative. Obviously, when you just look at this trend alone and you don't have that big picture in mind, it's easy to miss a lot of the important things, such as you may try and extend a trade too far because you don't understand the bigger picture, or you might not be considering some of the areas where trades are likely to come from. So what we can do now on the 4 hour time frame is actually within this trend see that there's the imbalanced extreme just here. So once again, going back to that point about extreme supply zones and demand zones, this is all efficient. There's no open space, there's no imbalance. Then we had this sell-off, we pulled back. This is efficient too. There's no imbalance here. But now we had a sell-off and we left open this supply. So this is what we would call the extreme zone within the 4 hour trend. So what we could do at this point is actually look for a sell trade from here, stops over the high, and we could target this demand because we know the market is trending down on the 4 hour and the big picture narrative tells us we can potentially buy. But first of all, we need to come and fill some of this area to fill the imbalance before buys become viable. So trade number one that we could look at immediately would be a sell from this area to target that demand. And then we will lead into that. And as you can see, we've then had a sell down, which would provide us with a trade opportunity. So now we could look for buying opportunities in line with this trend. And in order to see that, we would want to see body closures above this level to change the trend. So just to break down the trend for you, we've got the shift here. Then we have this downtrend formulation through here. And now we're in this area. So if we could break and close above here, we could look for buys to go higher. Now, what we can also do while we're here is refine a little bit more to the hourly to see if there's any open areas below. And now this makes things a little bit more obvious from that liquidity perspective because we can see that we do indeed have imbalance or open price range here that could act as a magnet area for price to lead us into this hourly extreme demand zone. Okay, so now if we get body closures here, we can trust in this zone, but with the liquidity and the imbalance below, we should more so be interested in the extreme zone if we were going to be looking for a buy. Now what you could do in this point is use your buy trade on this zone and target the upside. And why do we know this as a trade? And why has this become possible for a trade when it wasn't previously? Well, that's because we have a big picture narrative. We know the market is likely to extend higher based on the fact that there's that open supply on the weekly and the daily, which if we didn't do top-down analysis, we wouldn't know existed. Therefore, this trade that we're looking at here would be totally invalid and it wouldn't be viable. It wouldn't even be on our minds because we wouldn't know that the market was likely to push towards that weekly area. So we could place an order there if we wanted to using the hourly refinement, or of course you could wait for a confirmational entry within that zone. And then of course, as we said, we will be looking to see if the market does break above this level here. We could lead into potential buys if we get a nice closure above. So let's see what the trend gets up to. We had a push. We haven't closed above just yet though. Now we're selling back down at the moment. And as you can see, the market is giving way to that level and trading us towards that hourly refined zone. So now from here, we could get into this position quite happily because we have the high time frame narrative in mind. We know that the market broke structure at this level into a new higher high. We know we have this open extreme supply that we could be targeting above. So buying from the extreme demand makes a lot of sense. So if we were to let that trade run, we will see that we do start moving in the right direction indeed. And pretty much all of this was built off of the big picture narrative moving into the smaller picture narrative, which allowed us to take advantage of these trading opportunities. Now, why does top-down analysis help so much with this, and why was it so crucial here? Well, that's because without doing this higher time frame analysis, first of all, we wouldn't have a clear picture as to which way the market was going on the high time frames. So we would have been confined to just trading the low time frame price action, in which case, yes, we probably would have got the short anyway because it made sense on the low time frames. But this long definitely wouldn't have been viable because we wouldn't have any reason to believe that the market was going to go up after it, of course, came down. So by carrying out this top-down analysis process, we identified a new trade opportunity. And of course, overall, we just had more clarity on the trades that we were looking at because we have that big picture, high accuracy, high time frame idea in mind. That's going to give us the most clear picture as to where we're likely to go. And then the low time frames are just utilized to find entries within that bigger picture range. So we're always trading kind of the weekly and daily perspective, but we're using the 4 hour and the 1 hour to identify the smaller trends and identify the actual trading opportunities within that bigger range. Now, top-down analysis is incredibly useful, but there are a few things that you do need to consider when you're trading with top-down analysis, because top-down analysis can formulate what looks like a perfect trade, but if you don't consider some other things, you might end up taking a bad loss, even if the trade looked good from a TDA perspective. So, we're looking at an intraday position opportunity here. Let's say you completed your top-down analysis from the 4 hour to the 1 hour to the 30-minute, and now you were using this 10-minute time frame, which I pretty much use as an alternative to the 15-minute, to identify an entry. Now we had a break of structure just here. The market pulled back, we executed a buy, and it moved up. Now, one thing you need to know about this trade, which you might not have noticed, is that this was at the start of London session. So this trade would have been executed at around 9 a.m., just past 9 a.m., and then it led through and closed out by around 11 a.m. So this trade took place at the start of London session. Now, this is important because if your top-down analysis sets up a perfect trade, but it's coming in at the end of New York session, for example, just before the Asia session begins, then the trade is not going to be so good, even if the top-down analysis looks solid. The reason for that is, generally through Asia, we see markets ranging sideways. And this is most relevant for pairs like Euro USD, GBP USD, USD CAD, all of the Europe and America based currencies. So if your top down analysis aligns with a session, for example, the start of London session or the start of New York session, then you are in for a very high probability position because you've paired the high time frame narrative with the lower time frame picture, and also you have session timing on your side. Now, if you've set up a top-down analysis picture and it looks really good, but it's prepped you a setup at the start of Asia session or at the end of New York session or something, then you're going to be set up with a position that might look good, but the timing is off. And timing is a very crucial element because with timing comes volume. So for this kind of position in London, we know around London Open, we're going to get a push of volume because many people are actively trading. We see this happen a lot, as you can see here, start of London, push of volume, start of London, push of volume. So if your top-down analysis aligned with the start of a high volume session like London or New York, then you would be in for a good position, but you need to make sure that your top-down analysis isn't aligning with out-of-session trades. Because everything could look good from a top-down picture, but if your trade is going to be opened at 9 p.m. and it's an intraday position, it's not one that you should really be taking because you're not going to have the volume on your side. Therefore, even if the analysis looks solid, the probability of the trade working is much, much lower. Another timing-based element that comes into optimizing your top-down analysis is economic data. The markets are driven by supply and demand based around the economic conditions of specific currencies. So the data that we get in terms of interest rates, inflation rates, employment rates, all of this stuff, it all has a big bearing on what price is going to do. So it's important that when you're doing your top-down analysis, it's not going to line up with you taking a trade into a big important piece of data. So to look at data, what we can do is use something like FX Street. There's Forex Factory, FX Street, Fastball. There's a bunch of different platforms out there that you can use to actually get an insight into the economic data that's coming up. And when we're trading, we want to make sure we're not trading through this red folder data. For example, today we have CPI data from the Eurozone. We wouldn't want to trade the Euro through this because that is going to be rather dangerous for us. And what it can do is actually shoot our trades off, and it's not just going to result in a normal loss, but it can actually result in an oversized loss because you're going to run into something we call slippage, which is where the market goes further than your stop loss because there's no one to fill the trade on the other side of your position. So top-down analysis is really, really good, but there's a couple things you need to consider in terms of timing, because if you get yourself drawn up in this overconfidence because you think, okay, this top-down setup looks really good from the 4-hour, the weekly, the daily, whatever. If you think it looks really, really good and it's an unstoppable trade, there are still things that can interfere with it, such as the time of day that you take the position, whether you're in or out of session. And also this data can have a really bad impact on your results because data can totally override a technical setup, even if it looks perfect. Right, now I'm going to give you 3 important tips to optimize your use of top-down analysis. The first one is to use the weekly and daily to get big picture views of the market, even if you are a low time frame trader. This is because you are going to see things that will save you from a lot of losses and also set you up with a whole week or more of day trades just by understanding the high time frame bias, which you wouldn't if you didn't look bigger than the 4-hour or 1-hour, for example. So if we were day traders, we were looking at this market on the 4-hour, we would pretty much directly be looking to sell. Okay, the market is definitely in a downtrend. Our opportunities would be just focused on continuing to sell. And if we didn't look at the higher time frames, we wouldn't know if there was any conflict as to actually areas the market might reverse from. So we would just be continuing to sell, which from a low time frame perspective doesn't look like a bad idea. But when we jump to the high time frames, you'll see why this is dangerous. So here we've jumped up to the weekly, and the weekly's presented us with something. So what we've actually got on the weekly is a demand zone just here in the trend. And we can also see that we've got an open imbalance supply zone above, right in the extreme of this weekly move. So what we've just learned, simply by looking at the weekly very quickly, is that we are in a potential area of reversal, even though it looked really good for selling. And we have a potential higher time frame area that we could target, which is above. So if we were looking at the 4-hour and 1-hour alone, and we were trying to continue to sell, well, we would have been victim to conflict. Because if you look what the market did the following week, we had just a nice drive to the upside, which traded us towards that area. And this took around 2 to 3 weeks, I believe. Yeah, 3 weeks, and we actually pushed all the way up. Now, if you looked at this weekly time frame, even if you're day trading, you could have shifted your bias pretty quickly. And rather than trying to continue selling all the way down without being aware that this demand zone even existed, you'd have been at a point where you thought, okay, the market is currently bearish, but we are in a potential reversal area. So what I'll do instead of just blindly selling is see if we get a reversal. And if we do, we can actually change bias and go the other way. Obviously, when we look at this trend from an hourly perspective, from where we looked at it previously, any trade you took since that point on the sell side would have been a loss. However, by zooming out and seeing that weekly perspective, you could have instead refrained from selling and then started buying instead, providing you with weeks, 3 weeks worth of bullish day trades, as opposed to just kind of marrying that short bias and hoping that it's going to reverse. The second tip for optimizing top-down analysis is considering trend relevancy. Now, you need to listen to this one. This is where so many people go wrong, and this leads to people failing in trading for absolutely ages when they don't need to. So in this example, we have a 4-hour supply zone. Forget about the context. Let's just say you had a concept to sell from this supply zone to target lower prices or whatever. Now, when we trade into this 4-hour supply, people look for a change of character or a break of structure to sell. So they think if they can see that reversal in the trend, that is going to confirm downside for them. That's true to a degree, but where people go wrong is they totally forget about trend relevancy, or they don't even know about it. So if we want to see the 4-hour trend reverse, well, we need to see the 4-hour trend reverse, meaning we can't go looking within the price action up here for a 1-minute or 5-minute reversal and then trust this for a sell and get angry when we lose. Because when we look at the 4-hour here, we are quite obviously pushing bullish in an uptrend, okay? So if we try and sell here on a 5-minute or 1-minute perspective, that makes no difference to this higher time frame trend. We can easily just get whipsawed out of this position because we are trusting the low time frame over the high time frame, and we know the high time frames are always going to be more accurate. So what you would want to see to confirm a real trend reversal here on the 4 hour would be, well, at least this low to break, more than likely this low to break, because what we're looking at here is the actual 4 hour structural movements of the market. Now, if the 4 hour structure starts to break, then we can start taking short positions because we know the trend is agreeing with us. But here's what most people will do instead. They will go to the 5 minute or the 1 minute, and they will see this small break in the trend here. And they will say, okay, we've had a break in the structure, so I can sell from this supply. So then people would place a sell here, and then they would look to extend it really far. And now, while you might be able to run this trade down a little bit for an intraday position from here down to the open imbalance demand, for example, what you shouldn't be doing is trying to extend this trade really far, thinking that this indicates a confirmed reversal. Because yes, the 5 minute structure has changed, but the 4 hour structure is still incredibly bullish. If we go back to the 4 hour, clean the chart up a little bit, and then let it run forward, you're going to see that there was no change in the trend, and instead the market just kept going bullish. So by failing to consider that trend relevancy and the time frame relevancy of where you're looking for reversals, you would easily take a loss here. And I see people losing in these trades every single day, all the time. Then getting angry at the markets and saying that trend trading doesn't work, when really it's not a problem with trend trading, it's a problem with your identification of what trends actually matter. If you're looking at the 4 hour, you need to see the 4 hour reverse to confirm something. So you would look for your change of character or break of structure on the 4 hour and 1 hour timeframes just to make sure these lows actually give way. You do not want to focus on a 4 hour supply zone and then jump straight to the 5 minute to look for a reversal. You've missed out so much important price action that even if the 5 minute reverses, the 4 hour could still be going very strong against your position. So the next tip for optimizing your top-down analysis is to look to the left. Now, this is a very easy thing to do, but it will give you a new perspective of very important things when you're trading. So a student of mine, when they were learning, they took a trade just here. So they were looking for a buy trade after this break of structure. So I believe the buy was somewhere down here, and they were looking for a buy from here. Now, this is when they were doing some back testing, and I ran them through this and helped them with this problem. So they were looking for a buy when the market came down to this level. However, you will see that is not what happened. Instead, the market sold all the way through. And the problem that this student had at this point was that they didn't have enough context on the bigger picture. They hadn't looked over to the left of the chart, and they hadn't seen something quite obvious because they didn't do that. Now, that's a big risk when you don't do top-down analysis. You're kind of ignorant to the bigger picture, and you're going to miss these big areas that are likely to either validate or invalidate trades. So what we're going to do, jump to the daily time frame, and we're going to take a look to the left. Okay, so on that lower time frame, the 4 hour, that trend reversal looked reasonably valid. But when we look at the daily here and we look over to the left, we can see we actually have two equal lows formed, bringing it back to that point about liquidity. That obviously makes the trade higher risk and lower probability. But the real important thing here is not that equal low liquidity, but instead when we look over to the left, we are going to see quite clearly this buy was taking place within an imbalance range. There was actually no meaningful area for a reversal to take place at this level. However, below, there's this imbalanced demand, which, as we know, is going to act as a magnet for price. So by going to the daily and taking a look over to the left, we see the buy has pretty much no notable grounds to take place on a higher time frame, and there's also a magnet below, which is going to draw price towards it. So by looking at this big picture, we would immediately see, okay, this reversal is not strong. We've also got liquidity. We're not buying from a meaningful area, and there's reason for the market to go lower. So rather than taking a buy here based on just the low time frames, we would view the high time frame, and that would pretty much practically, almost guaranteed, help us to avoid taking this loss, because when we look at it from a big picture, it makes absolutely no sense to buy there. See, this is the problem with low time frames. They can form noise and they can form setups that look good, but when you look at the bigger picture context, which is really what top-down analysis is all about, you're going to see some of the trades you're looking at really are not that great, which is not a bad thing because it's going to save you from losing on those positions. So always look to the left when in doubt and see if there's any areas that the market is likely to react to or get pulled towards. So that's exactly how you do top-down analysis and optimize it. If you want to learn how I use top-down analysis to take trades like this and make money like this, and that my students have also used to acquire around $18 million in funding and make upwards of $5 million in real profits, then click the first link in the description. That's going to take you to a video showing you how you can leverage my systems to build the success for yourself. With that said, I hope you enjoyed the video and I hope it's given you some value. If you did, please drop a like and subscribe to the channel so you can get all of my future educational videos. So that's all from me. I'll see you in the next one. If you enjoyed that video, you might want to watch this one too, where we dig into Japanese candlesticks and show you how to trade these successfully.